Hi, everyone, and welcome back to another Real Vision Masterclass sponsored by DeFi Development Corp. Over the past year, we've seen a growing number of public companies experimenting with digital asset treasuries, companies whose balance sheets are, kind of built around accumulating and compounding crypto assets. And of course, one of the more interesting examples of this has been DeFi Development Corp. And joining us today, we have Joseph Onorati, CEO of DeFi Development Corp, or DFDV. Joseph has been in crypto for over a decade, including helping scale Kraken through some of its biggest growth years. And we have the pleasure of him joining us today. Joseph, thanks so much for joining us. How are you doing today?
Thank you. I'm doing great. Appreciate being here.
Of course, and it's great to have you. So we recently spoke with Parker about the strategy behind DFDV, and today we're going to go in, deeper into how DATs actually work, why they exist, and what they could mean for the future of capital markets. So let's just begin. And, since we're talking about DATs, and I know Parker kind of gave us, his take on what a DAT is, but I want to ask you, Joseph, directly for our audience. Can you explain, what a DAT is, or what a digital asset treasury is, and how they function?
Yeah, sure. Yeah, digital asset treasury or DAT. It's a company, almost always a publicly traded company. I think it only makes sense when they're publicly traded. That has a goal of growing crypto asset per share. So in DFDV's case, the goal of the company is to grow Solana per share, or Sol per share. And these companies do this through a variety of ways, but one is that DFDV does, and we see in many of the other DATs, is native staking. So for a proof of stake asset like Solana or Ethereum, the DATs will stake their assets, which generate yield denominated in the underlying asset, resulting in crypto asset per share growth, Sol per share growth in our case. And I think additionally, a DAT ought to, and we see this in, namely the most successful ones, Strategy in particular, ought to provide leveraged exposure to the underlying asset. And that leveraged exposure, be it via convertible debt or preferred stock, example being Stretch STRC issued by Strategy, allows the DAT to have very long-term duration leveraged positions in the underlying asset that should result in, assuming the underlying asset is appreciating, outsized performance for shareholders of the common equity in the DAT.
Let's get some facts. 37% of you aren't subscribed to this channel. That's almost 4 out of 10 just freeloading the alpha. So come on, hit subscribe, and I promise to keep leveling up the show with the best guests and the juiciest insight. Go on, do it now.
And one of the things that's really interesting about DATs like you guys over at DFDV, and because you guys are on Solana, right? And you mentioned Ethereum and Solana, you have the staking capabilities. And traditionally, we think of MicroStrategy in this context, and Bitcoin does not have those capabilities. So it's just a very interesting little dynamic. But you said something that I wanted to ask you directly about, because it is the case that we have seen about DATs, being in the form of public companies, and you said it almost doesn't really make sense for them to be private. Can you explain that a little bit? Why public over private, and why does private not make so much sense as opposed to public?
Yeah, this goes into the ability to get leverage to essentially borrow. So if you think about kind of a range of possible credit opportunities for a company or even an individual, actually I feel like I'm channeling Michael Saylor right now, because he's got like a slide on this where they've tried basically everything. But if you think about it from the perspective of, say, an individual crypto trader or a small crypto fund, then those individuals or funds can borrow or get leveraged exposure to crypto assets via a few ways. So, but almost all, or maybe all, of the ways that they can get exposure are secured. So, for example, if you take a margin loan in like a brokerage account to buy Bybit the Bitcoin ETF or one of the Bitcoin ETFs, if Bitcoin tanks, you're going to get a margin call and you could get liquidated, right? So, and that debt can be, short duration. Likewise, if you're trading on a crypto platform, maybe you can take a margin position on the crypto platform. Same situation, and the cost of capital can be very high there. Then if you kind of move out to, okay, derivatives, this is better, but probably not perfect. So, for example, you might be able to trade perpetual swaps in, on Binance or something, right? Where you can get significant leverage, and the cost of that leverage is variable. You pay the funding rate, and in a bear market, the funding rate might be very low, so the cost of borrowing and levering up might be very low, but you still have that debt secured. Like you're going to face a real-time liquidation if the market moves against you, and your whole account can get wiped out. And this is kind of a feature from the exchange's perspective because it protects the exchange and allows them to provide leverage to their clients. Then, this is taking me a bit, but I'm going to get to why the
No, this is
public
very
market makes a
important,
lot of
valuable
sense.
info. Yeah.
And then another way that you could borrow or lever up is to go on chain, but all the on chain borrowing is over collateralized. So you have to put up your Bitcoin or your Sol or your ETH or your stable coins or whatever to borrow other assets. To borrow your stable coins to take a leveraged long position on Bitcoin or ETH. And the cost of capital might be really low for this. You might be able to borrow at, I don't know, 4, 5, 8%. I don't know, that it varies. And the leverage ratio might also be pretty good compared to what you can get on a margin account, but it faces the same issue. If the market moves against you, you're going to get liquidated, and your collateral is going to get sold to cover your debt. Now, if we kind of so that's how individuals lever up on crypto. It's also how certainly small funds lever up in the crypto space. And now, if you think about how public companies can leverage the kind of access to global capital markets, or maybe especially U.S. capital markets, gives these companies the ability to raise capital and to borrow in ways that are just simply not available to individuals or smaller funds. And now I did say, it doesn't make sense to do this in a private company. I guess theoretically there could be a private company that's large enough that they have access to some of these alternative methods of financing or getting leverage. But I mean, that's going to be a very large and very reputable private company to be able to get this access. So in the public markets, you can raise money via, for example, and we've seen this, DFDV's done it, and with Strategy, it's also done it, is convertible debt. And the convertible debt comes in flavors, but the two converts that DFDV has raised, and all the ones that Strategy has raised, and I think for many of the other crypto companies, though some of the smaller dApps have done secured deals, but these deals are unsecured. So the duration can be 5 years, 5.5 years. There's 6-year ones out there. And essentially the way these work is as long as crypto is higher than it is today, 5 or 6 years from now, which feels like a no-brainer, then these loans can't be liquidated or called. Right. So, for example, I've probably heard in MicroStrategy's case, like their liquidation price on their loan is, I don't know, $20,000 a Bitcoin or something, right? Like I've heard people say this before. I don't even think that's true. I think it's lower. But it doesn't matter what happens to the price of Bitcoin in the short term with an unsecured loan, or the price of Solana with an unsecured loan. And this is a financing method that's available to public companies that's radically better and safer than the financing methods available to individuals or funds in the crypto space. And it actually gets even better than that. Convertible debt's just one of the pieces. Kind of the next level up And what I think is going to be incredibly popular in the market in the short term, and that we're also building a product around outside of DFDV that I'd like to talk about, is preferred stock. So the kind of modern flavor, that flavor doesn't sound quite right. I think this is like got sticking power here, but it's variable rate perpetual preferred stock, like Stretch, STRC. And from the DAT's perspective, the DAT can raise the preferred, which is essentially borrowing, and they never have to repay the loan. So it's perpetual. So they raise the money, they keep it forever, and they pay a dividend on it. Monthly is seems to be the current norm. Stretch pays monthly. Theta by Strive pays monthly. If DFDV issued a pref, it would pay monthly. And the interest rates on this debt varies. So the preferred stock issuers target a particular price. Like, okay, we want $100. That's a par. If the price goes down, we increase the interest or dividend rate. If the price goes up, then we decrease the interest or dividend rate. And this is the kind of new, most popular, and I think going to have incredible growth method for financing digital asset treasuries. And again, the beautiful thing about the structure is that it's unlimited duration. It doesn't matter what the price of the underlying asset gets to. This loan doesn't have to be repaid. You just have to pay the dividend payments. And from the investor's perspective, they're kind of taking a bet, like, okay, yeah, Bitcoin's probably going to be higher, 10 years from now, or Sol's probably going to be higher 10 years from now than it is today. And as long as the company, the DAT, can continue to make the dividend payments, like Strategy set aside 2 years of cash to make their dividend payments, then I think this is a good bet. And, they're yielding what I think it's 11.5% now in dividends. And okay, my very long monologue is over. But the the reason that public companies are better than private company or individuals for getting leveraged exposure to crypto is the method of financing to which they are exposed, the primary ones being convertible debt and now variable rate perpetual preferred stock, where the key difference is that this debt is not secured and the volatility of the underlying is irrelevant in the short term and even the medium term for these companies, so they can hodl for virtually forever. Uh, and as long as the assets are appreciating in the extreme long run, the investors are in a good spot.
Mm. Now, this is exactly why we call these Real Vision master classes, because that was like, you literally just gave us a master class into all of that. And I think it's pretty clear that the being a public digital asset treasury has clear advantages, especially like the way you just completely just laid it out step by step and the different ways they can do that. So Joseph, really appreciate that, and I'm sure our audience does as well. So one of the things you kind of touched on in your answer was about exposure, right? And I think when people think about investing in crypto or getting exposure to crypto, they typically think of it in I think one of two ways, right? Either buying the token or getting into an ETF, right? So want to ask you, who is the ideal investor for a digital asset treasury? Is it like traditional equity investors, or is it like crypto native people, maybe institutions looking for exposure? Is it all of them? What's your kind of take on that?
Uh, uh, I might have a bit of a marketing problem, so I've tried to narrow this to as tightly as possible, but I keep growing it. After we narrow, and then I say, well, that's bullshit. Maybe I can't say that. Um, but I think it's anyone who wants exposure to crypto. So, I, for example, uh, if you just want price exposure to Bitcoin, for example, if you would buy Bitcoin in your Coinbase account, say, then from pure financial perspective, it makes more sense to buy DAT. Like, I'd rather buy Strategy than Bitcoin in a Coinbase account if I was just going to leave it in the Coinbase account. Now, if you're into the not your keys, not your coin, um, kind of ethos, which I happen to be, then it makes a lot of sense. I think that's a good argument. Then if you want self-sovereignty, you want to be your own bank, etc., then uh, you probably need to buy the underlying asset, hold the underlying asset, and use it. Uh, so that would be kind of the split for me on users who just want financial exposure versus users who actually want to use the cryptocurrencies. And then if you're currently or interested in ETFs for crypto, I think the DATs are fundamentally superior to ETFs, and I think in the long run, the DATs will flip ETFs. I think ETFs don't make sense um, for crypto in the long run because in an ETF, you're limited on what you're able to do. So, some of the ETFs are able to stake now, and some might sell, like covered calls or whatever to earn yield on top of the crypto asset. But the DAT has a lot more flexibility on what it can do with the underlying asset to generate yield. It might be able to lend it to these investors who are over collateralized or borrowers who are over collateralized to generate yield on those assets. They might be able to um, I don't know, just manage the balance sheet assets in a way that generates additional yield. So and they can be flexible on the exposure to leverage that they get. So I think I guess if we kind of zoom out, I think it doesn't make sense in the long run for like crypto doesn't fit in an ETF. I mean, they are kind of shoehorned in now, but I think in the long run we're going to see, especially the bigger DATs, just displace the ETFs. And if you look at the long-term performance of strategy, say since it adopted crypto treasury, it's radically outperformed Bitcoin, and I think the certainly the higher performing DATs will also radically outperform the underlying and the ETFs. And if the balance sheet's big enough, you can get kind of the management expense ratio, you might say, in an ETF down to even in a DAT in the ETF range or lower than ETF range when these companies are at scale.
Now, we touched on price a little bit. I want to ask you, because I've been hearing a lot about, kind of DATs and how they're kind of this treasury flywheel, right? And I wanted to ask you directly about is it basically this dynamic, right? Share prices rise, you raise capital, buy more SOL, increase SOL per share, attract more investors. Is that kind of how that flow works, or am I like missing something in kind of how this all operates?
Yeah, I think that's appropriate to say. Yeah, I'll go into a couple of the potential flywheels. To be candid, though, we do a presentation. DFDV does a presentation on the Bitcoin Treasury flywheels, and it feels kind of circular to me. Now with staking yield, you kind of break out of it, so maybe take into consideration that this might end up. I mean, it is a flywheel; it's already a circle, so. We'll see what that looks like. So, uh, the treasury companies have a notion of MNAV, multiple on their net asset values, and this is one of the ways that investors look at how to evaluate these companies. The trouble with MNAV is there's like I don't know at least 6 ways to measure it, and if you go to DFTV's website, DeFiDevCorp.com, we have a NAV and SPS page, and it lays out 6 ways to measure it and the mechanism. So if you're interested in learning more, I recommend you check it out because it kind of informs investors on how to evaluate other DATs that may have like one headline MNAV number. But ultimately, the DATs will pick like a version of MNAV to which they subscribe, and then uh, if the MNAV is over 1, the DAT ought to be issuing more stock, selling common stock into the market and buying the underlying asset. And when they do that, that should grow crypto asset per share, SOL per share in DFDV's case. Um, and that's kind of a flywheel by itself, right? As long as it's kind of self-fulfilling. Like if you're able to grow SOL per share by issuing when you're at a premium to your NAV, then you can go tell investors, well, look, we grew SOL per share by 20% or whatever last year. I just made up a number there. We grew it by a lot more than 20% last year at TFTV. Um, then, you ought to value us at a premium to our NAV and therefore buy more stock so we can issue more equity and buy more of the underlying. And then the idea is that this flywheels itself into infinity. But we haven't really seen that play out in, I guess, since there's been a flood of digital asset treasury companies in, say, the last 10 months. And we've seen MNAVs compress. Many MNAVs are below 1 for DATs today, and therefore it is not accretive on a crypto asset per share basis for them to issue new stock. So the flywheel is halted.
Yeah, well, I'm glad you actually mentioned that, because that directly leads me into my next question, because it all sounds great when the flywheel is working and the underlying asset is rising, in this case Solana, right? And seems like I completely understand how that can work and you attract more investors. But like, what about on the opposite end of that? And the underlying assets going down, market conditions aren't so great. How does that work? And how do you, I guess, kind of protect yourself and your investors against that situation?
Yeah, well, I think different DATs have different approaches to this. So we're seeing many of them kind of flee the market. Like a lot of the DATs that were DATs a few months ago are saying, "Whoa, I don't want to be a DAT anymore. I want to be valued differently. Don't look at my MNAV. Let me delete MNAV from my website and stop talking about it, and run away from this narrative. Oh, let's buy like a different business that, oh, we're going to become a real world asset issuer, or we're going to pivot completely." So we've seen some of that, but another way to think about it, or to look at this, is if the DAT trades at a big enough discount to MNAV, then the DAT should or could sell the underlying asset and buy back the stock. And if they do that, they would be growing crypto asset per share. So we've actually done some of this at DFDV, so we earn our staking rewards. We're never going backwards on the SOL holdings. Sell off some of the staking rewards, buy back the stock, and it grows crypto asset per share. So investors are, you said, I think, protected. So in that sense, I'd say investors are advantaged, shareholders are advantaged. Parker and I are major shareholders in DFDV, and we think this is a great idea from the perspective of growing SOL per share. Now, I think there's another way to break out of this that we're going to see DATs participate in, and we've seen Strategy do it and now Strive, which is issuing the variable rate perpetual preferred stock. Because if you can issue preferred stock, then the common is not diluted, right? They're just taking leverage onto the balance sheet and buying the underlying asset. So in that case, the crypto asset per share increases, and we take this, I'd say anyway, very safe and long-term kind of debt exposure via preferred stock issuance. I'd like to go into that if that's okay with you, if we can take in that
I would
direction.
love that. Yes, please.
Yeah, I think this is like the next evolution of DATs. Some of them are going to kind of go away. There's going to pivot out of being a DAT. They're going to have kind of shareholder action to push selling the underlying asset or to push an acquisition. But I think the sort of the strong ones, and we see this with Strategy, right? Like they're really pushing Stretch now. That's like the primary goal for the company is pushing this asset. And so let me step back and talk at a high level about what the structure of these instruments are and what I think we're going to see. So, a preferred stock for a public company can issue a preferred stock, and uh, most public companies have what's called, or many public companies have what's called S3 eligibility. So they've already done a filing with the SEC that says, hey, we want to be able to issue more stock in the future. SEC reviews, signs off, whatever the right word is, doesn't block it. And often included in these registration statements that are referred to as a shelf, they just sit on the shelf and you can use them whenever, are preferred stock issuance. Virtually all public companies have some amount of like preferred stock set aside that they can issue. And companies basically just get, a capital markets attorney, an attorney who understands this stuff, writes up the terms of a new financial instrument, and it can be traded on public markets. So, for example, Strategy, issues multiple preferred stocks. The most popular one is Stretch STRC. But to put this in perspective for like how difficult this is to do, it's not very difficult. If your lawyers can describe it, and you have your shelf registration, or you can file an S1, you can get one of these out into the market as long as there's buyers for it. An investment bank will help you find buyers for it. It has to be a good product. It has to have demand. Investors actually have to want to buy it. But if there's investors and you have an idea of what the financial instrument ought to look like, then you can probably issue it as a public company, and you can probably sell it into the public market. Assuming investors actually want to buy it. And so, I don't know, it might cost like only $500,000 to issue these things. I mean, there's not a high barrier for a company that's already public to do this. So, I think that kind of once the other DATs kind of figure out how good this is, and the market turns around a little bit to where the crypto market turns around a little bit, such that investors are willing to buy these in the IPOs, then there's going to be a bunch of them. I think there's going to be, 10 or 20 of them or whatever issued, say, in the next 18 months. And these instruments, as I mentioned before, they're not common stock, and they don't have any right to convert to common stock. So they're not dilutive to common shareholders, and they help the company raise money. So if essentially via a debt-like instrument that is publicly traded, and you can buy it in your Robinhood account. So Saylor and the folks at Strategy say there's like layers to this. So Bitcoin is, I think, digital capital, and then Stretch, which is a credit product that they, are issuing out of MicroStrategy, is credit built on top of Bitcoin, issued by a U.S. public company with an enormous balance sheet, whatever it is, $40 or $50 billion of balance sheet. And that credit instrument is yield bearing and fairly liquid, on the way to more liquidity, hopefully. And then they say, and we're working on this, there's a third layer called digital money. The digital money layer but I'll get into that in a minute. I might be on a bit of a rant. I'll pause. Any questions or follow-up maybe on the variable rate perpetual preferred stock before I get on
No,
to
I wanted
the
to actually.
instruments?
I was actually hoping for you to get into digital money. I'm like a fly on the wall, just loving what you're saying right now.
Okay. All right. So, from my vantage point, anyway, as CEO of a DAT, I think there's going to be many of these digital credit instruments. Likely Stretch will be kind of the apex digital credit instrument, though, because Strategy has the largest balance sheet and probably has the lowest cost of capital compared to the other DATs, though SATA SATA issued by Strive is only like, I think, 1% higher dividend rate than Stretch now. So maybe there's opportunities for more of these companies to issue and have Strategy like rates. But kind of setting that aside, I think there's going to be a bunch of them. There's going to be a lot of experimentation in the market on what these instruments ought to look like, and it's going to be really interesting to watch how it unfolds over the next 6 to 18 months. Now, the digital money layer are financial instruments built on top of these variable rate perpetual preferreds. So some of the team at DFDV have formed like they're working on a different business. It's another project called Apex, APYX, and Apex is a stretch-backed stablecoin product, and this is issued on Ethereum, and you can check out the website apyx.fi, fi. But this is just one of, I think, many products that will be built on top of Stretch. And the products that will be aren't necessarily just crypto native. There'll be a variety of stable coins. There might be instruments built on top of that as well. But we'll also see funds, we'll see ETPs, we'll see baskets of these variable rate perpetual preferreds, I think, in the longer term. So, for example, you might see instruments that further reduce volatility in exchange for lower yield. You might see leveraged instruments. Like investors might want to bet that Stretch is going to repeg to its $100 par target, but there is volatility, and they're willing to take the volatility in exchange for, double yield or something, right? So there could be some kind of tranching financial product built on top of Stretch. I think that's definitely coming. Of course, there'll be stable coins built on top of Stretch. We're working on it already. I mean, it's out there, launched last week. And then there'll be ones that drive utility to these instruments. So, for example, maybe there'll be like a euro-denominated one or a yen-denominated one that are kind of wrappers on top of the highly liquid U.S. market one denominated in U.S. dollars that try to take out the foreign currency volatility for these instruments for investors in the relevant geography. And I think just I don't know, a tidal wave of these kind of instruments are coming, and I'm very excited about it.
Yeah, I mean, you basically just explained. I mean, I just see a whole new financial ecosystem being created essentially with all of this stuff. Now, this might be a very simple question, but does it make sense, in your opinion, for DATs to hold like multiple underlying assets? Like, you guys are Solana based, but would it make sense to hold like Solana and Bitcoin and ETH, or does that like start getting too confusing? How do you think about that?
Yeah, my view on this has evolved a bit. So, no, my quick answer, no, I don't think that makes sense generally. So I think that investors probably want to choose the exposure that they have to individual underlying assets. And if you want exposure to, say, Solana and Ethereum, then, you can buy DFDV stock and you can buy SharpLink SBET, for example, an Ethereum DAT. So that choice already exists in the market, and I don't know that. I worked at Kraken for a long time, and I've looked across these various exchange and OTC provided products in the crypto space that provide exposure to baskets of crypto assets. And I guess I appreciate what they're trying to do for investors in some way, but I think they generally underperform the investors just picking the underlying that they want exposure to. So it's kind of, what do I think is better for investors? And I think that, doing their own research and making their own choices about what they have exposure to probably makes the most sense. However, there may be advantages to, like active treasury management across multiple assets, and I could see DAT doing that. That's not what DFDV is going to do, and I don't think it's kind of it's not the approach that I would take or the approach that I would take to, how do I put that? If I wasn't an investor, I wouldn't buy it, but I could imagine other investors buying it. So there's probably demand for it. And I know there's a couple of dads who are trying to do that already, but yeah, not for me.
So, a quick break in your regular programming. If you're serious about your future, grab my free report called Prepare for 2030. I think you've got 5 years to make as much money as possible, and this guide will help you navigate what's coming. The link is in the description. Download it now.
Yeah, understandable. I am a big fan of the saying, "Jack of all trades, master of none." So I think that is aptly fitting here. Now, talk to me about staking. What are the pros of having essentially like Solana's stakeable asset, Ethereum's stakeable asset, Bitcoin not really, right? But there are ways you can kind of play around with that, right? We talked about what MicroStrategy is doing, but like what specifically are the pros to operating a digital asset treasury with an underlying asset that you can actually stake and generate yield off of beyond just like you creating new products that help with that?
Yeah. Maybe I'll start with what it doesn't do, because I think that matters maybe more than what it actually does. So the way staking works for many of the proof of stake projects is there's a inflation rate for the token. So let's say the inflation rate, they just minting, I don't know, new assets at like 4% a year. So it's just like inflation for dollars. There's 4% more, crypto asset token X per year than there was previous year. And that 4% gets distributed to holders of the assets who are staking. So let's say in the 4% example, only half of the assets on the whole network are staked. So that 4% would be distributed to only half the users. So the other half of holders of the asset are not growing their asset base, while all the ones who are staking are accumulating the entire 4% channeled into only 50% of the holders. So if a to take that to the next step, if a DAT is not staking, then they're essentially losing, like as a percentage of the total asset base. So I think staking is kind of table stakes for a DAT, right? Like if a DAT's purpose is long-term accumulation of the asset and to grow crypto asset per share, the DAT must stake all or virtually all of its assets, or find some way to earn more yield beyond the staking rate that it then uses to purchase the underlying asset. So in from one perspective, it's neutral to stake. From the other perspective, as long as not the entire network is staking, then there's disproportionate growth for the underlying asset for the stakers. Now, so in that way, I think all the DATs have to stake, and it is beneficial to stake because of the kind of redistribution from non-stakers to stakers over time. Now, I think the key advantage to staking or running a validator, specifically running a validator, we run our own validators. Parker, who you all talked to before, has been running Solana validators she's coming up on 3 years now. And we brought this validator into the business coming up on a year ago now. And so we've staked most of our balance sheet assets to the validator, but this gives us an opportunity to grow stake on our validator, and when third parties stake to our validator, we generate revenue. So this is another kind of differentiator for DFDV, because we have this validator operation. And then we've also we've adopted a liquid staking token, an LST, and ours is DFDV Sol, which is, if y'all are in the Solana ecosystem, is a Sanctum LST. And Sanctum is a provider that facilitates the creation of liquid staking tokens. And so normally when a user stakes Sol, the stake account is locked. Like you can't use the Sol and the stake account for much of anything. And what a liquid staking token does is it essentially gives you like a receipt that says, hey, this is a claim on staked Sol, and then that liquid staking token becomes liquid, and it can be accepted across Solana DeFi. So you can use it as a collateral asset to borrow. You can trade with it. You can use it as a collateral asset for trading. Um, and we have done a lot of work to drive adoption of DFDV Sol. So it's accepted as a collateral asset across all the major lending markets on Solana and other parts of Solana DeFi, and it's one of the higher yielding LSTs. So that's been a big advantage for us. It's gotten us a bunch of partnerships, kind of brand recognition across the ecosystem, and third-party stake to the validator, because the validator is the kind of source of yield behind all of DFDV Sol. So when a third party holds or uses DFDV Sol, we get a small piece of their staking rewards.
Now, one thing that I'm really interested in, especially, with your background at Kraken, you've seen a lot of assets, probably too many to even count. Yet you guys, you decide, when you guys started DFDV, you decided to go with Solana. Why is that? Why did you choose Solana over, maybe an Ethereum, or, well, Bitcoin's not stakeable, but over another asset? Why specifically Solana was attractive to you?
Yeah, look, I get asked this question a lot, and honestly, it was personal conviction in the asset. So, we did the transaction back in April of 25, and I was talking to Parker. We were working on this back in, say, January, February, and we've both been participating in Solana DeFi as users since mid 21. And like I said, he'd been running Solana validators for 3 years now. And the user experience on Solana is fantastic compared to many of the other layer ones. And if you look at DFTV's Twitter, we just post metrics on Solana, and uh, they're winning. Solana's winning on wallet growth, transaction throughput, capital efficiency, metric after metric. And uh, yeah, it's a great user experience. If you haven't used, or like if you've used Ethereum mainnet and you haven't used Solana, I'd say just go try it out. It feels like you're using a modern product instead of one, developed over 10 years ago. Um, it's really fast, and uh, feels like feels like a Web 2 experience in a Web 3 environment.
Yeah, as someone who, when I first came into this, into crypto world, I think like most people, I obviously came in through Bitcoin, then found Ethereum, was using Ethereum, playing in that ecosystem a bit, and then I found Solana a bit after. And let's just say the main ecosystem I'm on right now is Solana. So I couldn't agree more with what you
Yeah.
said there, Joseph. So I appreciate that. Now, we talked about staking, right? And we talked about kind of how, DATs can grow and kind of what that flywheel looks like. So I think one thing that I've seen kind of said about that, I don't know if I want to, I guess, if you consider the crypto world, I guess it could be considered a criticism, but essentially as digital asset treasuries scale, right, they could end up owning a large percentage of the circulating token supply. What are your thoughts on that?
Yeah, for the proof of work chains, I don't think this matters. Uh, it's probably great. Like you just kind of get a pass-through ownership of the underlying via holding the common, right? And would kind of think of that with strategy, and I think that's totally fine, not a problem. For the proof of stake chains, I think this is a bit more of an issue, where you don't want centralized control of large amounts of stake, generally speaking, or the ecosystems are generally kind of opposed or fearful of this. And when we launched DFDV, I was very bullish, and I was like, "Whoa, what if we end up owning, like too much Sol? Like, is this going to be a problem?" Because I'm like, one of these guys, and kind of after reflection, I think that that was probably not quite the right way of looking at it either, because uh, ultimately the shareholders, um, have say in uh, what the company does. So, it, it's similar to my answer on the Bitcoin ones where, oh, I think it's fine. Well, the shareholders have kind of pass-through control over what happens with the assets. And then also, I think the DATs, at least the successful ones, will be fantastic custodians, or custodians, is that the right word? Like guardians of the ecosystem in
Right.
the longer run. So, for example, uh, we see, I'm going to reach a little bit here, but Mara, the Bitcoin mining and treasury company, they spend a lot of time on like quantum proof education on Bitcoin. And they probably spent like an outsized amount of money on it relative to many of the other crypto companies. And I don't know if they might be insulted if I said they were a DAT, but they hold a lot of Bitcoin. So, I think we see that. Uh, it's almost like if the DAT holds enough of the asset, they're kind of like mini foundations in a way, where they're out promoting the asset. They might be um, working on open source tools for the asset. I mean, and if these projects or ecosystems are actually decentralized, then uh, the DATs probably ought to have like roles as kind of ecosystem shepherds, right? Like they should end up being kind of the good guys in the space because they really want the asset to appreciate, right? That's how their management teams are going to be the most successful. Their boards are going to be most successful. Their shareholders are going to be most successful.
Yeah, I guess maybe the concern might come from people being worried about the ones that maybe aren't going to act as the guardians, and like I guess influencing validator sets and like an overall governance if they get too much of the supply. But I kind of like the way you put that into perspective. Um,
Yeah, I don't know. I mean, I feel like that was probably a concern earlier on when it's like, oh man, these DATs are growing so fast, they're raising so much money, uh, and there's like a centralization scare. But I think in the kind of current state where essentially the DATs are trading below 1x or around 1x NAV, the growth is limited. One of the ways that the DATs kind of differentiate themselves from each other is by their kind of ecosystem stewardship. And the good actors, I think, will be rewarded with a premium essentially, or of easier access to more capital, and so kind of the good guys win in the long run, and it's probably the right outcome for the ecosystem. I'm happy to be challenged, but current thinking.
Appreciate that. So, so we're kind of seeing like that's, evolve. Like, as you kind of explained, we're seeing them evolve more, beyond companies that just hold tokens, right? You mentioned how you brought in Parker's validator, right? You mentioned many like products and stuff that they're doing with liquidity. Where do you see this? Like, where do you see DATs in this whole ecosystem, like, 5, 10 years from now? Is it kind of like, how do you see them evolving? Is I guess my basic question for you here.
Yeah. Uh, 10 years is a long time, so I
Yeah.
think um, in the long run, fiat's going to zero, and therefore Bitcoin in particular, but other crypto assets are going to infinity. And as that happens, I think uh, this preferred stock issuance and the digital credit layer built on top of DATs as they grow from here becomes a more and more key kind of part of the global financial system. I think we'll see products like Stretch and the products built on top of that, like Apex, APYX.fi, that we'll see them almost take share or grow as a percentage of the global credit market. So this would include, bonds, fixed income, right, treasuries even. I'm lumping in there because, ultimately I think investors are going to choose, over this longer duration, they're going to choose Bitcoin-backed or crypto asset-backed credit over, what is it, the faith in the in states essentially. And I don't know, that seems like pretty clear to me, and the long enough time frame, and 10 years is probably long enough for that.
Yeah, I mean, this 10 years is like 100 years in this space, right? We're
That's
moving
right.
just so fast. Like, I mean, I just think of the AI stuff, like where it was 6 months ago and where it is now. It feels like it was 10 years of development within that 6 months. So
Yeah.
great perspective you have here, Joseph. Last question for you before I let you go here. We discussed a lot of things today, right? And I really appreciate you just really giving us a true masterclass. When we started these series, this was exactly the type of conversations we had in mind. And so I just want to kind of leave it to you after everything we've discussed today. What is, what are like some key things, or like what is one key thing you want people to take from this conversation today?
Yeah, I'm really focused right now on these preferred stock issuances, and I think if I was going to talk about a trend that is probably not seeing enough light, it would be that. So I think these variable rate perpetual preferred structure issued by digital asset treasuries, I think there's enormous growth potential there. I, would recommend that listeners or viewers have a look at those products, be it Stretch or SATA, or if DFDV issued one in the future, and then also the instruments built on top of them. And I think right now these markets are small. Like the total assets issued is probably around 3.5 billion in these variable rate perpetual preferred instruments, but by 2030, so we're looking at least 100 billion. Maybe it's much faster than that in these assets, and that's big enough for an incredible array of products to be built on top of them, which is why some of the team here has been working on Apex, which is the stablecoin product built on top of Stretch that passes through the yield from Stretch and the other variable rate perpetual preferred into a stablecoin product.
Joseph, it's been an absolute pleasure. Great conversation. Thanks for joining us. And everyone watching, thanks again for tuning in. This has been a Real Vision Masterclass with DeFi Development Corp, or DFDV. You can find out more by heading on over to DeFiDevCorp.com. And let us know your thoughts, guys. Let us know how you guys think about digital asset treasuries, and how, just how you guys are feeling about their future. So thanks again, everyone. We'll see you on the next masterclass.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.